Coming up on the SBS On the Money podcast, my interview with BHP CFO Vandita Pant on the growing copper business and the future for iron ore. Plus, we take a closer look at AI and why it'll be an investment theme for the next decade. All of that and more next. Hi everyone, welcome to the SBS On the Money podcast for this Tuesday, the 17th of February 2026, a day where the Australian share market rose, the S&P ASX 200 up 0.2%. I'll have some details with Jonathan Shead from State Street Investment Management in a few moments. But first, shares, the world's largest listed miner, that's BHP, hit a record high today as it delivered a $5.6 billion half-year profit. That's up 28%. BHP also increased its dividend by nearly 50% to 73 US cents per share. Its CFO, Vandita Pant, told me a deal to sell the rights to future silver production from one of its mines will help fund future dividends. Now, the miner saw record half-year iron ore production, but it's copper which proved to be instrumental. And to tell me more about that, I spoke with the CFO, Vandita Pant.
Well, Ricardo, for this season, for a half year, half of our earnings were copper. And this is part of the execution of our strategy for last 2-3 years that our copper exposure has grown. For example, in Escondida, which is a mine that we have in Chile, this year, not only it has delivered very well, but we are increasing the guidance for this year for Escondida and for next year. Overall, copper now being half of EBITDA, and not only that, we have a suite of really great, attractive growth options in Chile, in Argentina, here in Australia, and in the US, which will further increase our copper growth and part of the portfolio. Last 4 years, we have grown 30% on copper, and next up to mid-30s, this will go up further by 40%.
It's interesting you mention growth, because the next question is about whether this growth will come organically or through acquisitions. Because to what extent is it all about scale? Because especially when it comes to copper, you know, your rival Rio Tinto has made no secret about wanting to merge with Glencore. How will BHP grow, especially in that copper field?
So very important to go through how we think of copper, or indeed any commodity. We do not think of growing for the scale of it, just for the sake of it. Our value lens is really important. And what we have is a rich suite of growth options, which are also very attractive. If you look at our capital intensities of growth of copper projects, these are some of the best options in the industry. So to give you a sense, from where we are to mid-30s, we grow copper by 5% on compounded basis. Another way to think of this is we are already the world's largest copper producer with the largest resource base, and will grow our copper equivalent tons to 2.5 million tons, including the byproducts for our share. This is a very rich tapestry of options. Now, we are a big company, and that does mean that we will look at inorganic from time to time. But our bar for inorganic is very high. It has to create real shareholder value, and we are very disciplined about it. But if I were to just say that if we were to execute just on our organic suite of options, our shareholders will do very well, not just now, but in future with this growth trajectory.
So with copper growing, you've also locked in a silver streaming agreement. You're expanding potash. What role do you see iron ore playing in your portfolio? And what extent does China fit in here, given the lower prices?
So actually, iron ore demand has been very resilient in the past 6 months, and China continues to produce 1 billion ton of steel. As you would have seen, that we've almost a decade back said that the iron ore market will start to, steel market will start to plateau, and with that, our strategy has been to really expand on the margin for iron ore business and become the lowest cost producer for iron ore globally among the majors. And that is exactly what our business has done. Currently, we make more than $10 a ton higher free cash flow, higher cash in VAO business than our nearest competitor. And that is an important one as the demand starts to plateau over a period of time in 20s and then gradually reduces. But iron ore will be a great business for us. And as you can see, we are investing in that business going from here to 305 million tons by FY28 as well. So we're continuing to invest in that business. It's a great business. And in the half, we had record production and record shipment. And iron ore prices have been good as well.
Vandita, shareholders would appear to be pretty happy because shares are at a record high, a near 50% increase in the interim dividend, a 60% payout ratio. So for those shareholders seeking security in dividend levels, should they continue to expect similar types of payouts in the medium term?
So our shareholders know that we really look for reliability with BHP. For past 20 plus years, our margins have been more than 50%. We have rewarded our shareholders over the last 10 years with more than $100 billion of dividends. And this performance gives us confidence and should give our shareholders confidence that we can manage good shareholder returns along with investing on behalf of our shareholders with attractive growth options while keeping our balance sheet really robust and strong. Our capital allocation framework means that every time 50% dividend comes as a minimum, and then based on the cash flow that we generate, either from our operations or indeed like the deal we have done today of silver, which has brought in $4.3 billion in cash upfront from silver, which is yet to be produced in our Antamina asset. All that cash comes into capital allocation framework, and then we allocate some to the growth and some to the shareholders. So I would say our shareholders can look forward to reliable performance, which means strong cash flows from our operations, every way in which we will unlock value and be able to give attractive shareholder returns with minimum 50%, but attractive shareholder returns with top-ups and attractive growth options, which means shareholders get value today, and there is a lot more to come.
Final question on the global economy. In the statement to the ASX today, BHP says it expects global economic growth of around 3% this calendar year, that China's economy is resilient, as you pointed to earlier, while India continues to outperform. That seems pretty optimistic. What gives you that confidence about the global environment, given the number of uncertainties out there?
So the confidence in the underlying global economy, as we said, around 3% growth, comes with very supportive backdrop of fiscal and monetary policies, which economies and countries are using to make sure that they can navigate any uncertainty. And as you said, we have said that we continue to see a real great momentum in India in terms of investment, in terms of advanced manufacturing base, and indeed with more and more focus on infrastructure going there, which is very good for both metals as well as met coal demand. China 15 plan, which is the 5-year plan that they do, which is very much focused on consumer demand, but also advanced technology while continuing their stronger exports. And then US very steady, and we expect that to be steadily growing with the backdrop of pro-investment policies. Overall, confident in the outlook, but also very confident in what we can control through being really focused on our operational excellence of executing with lowest cost possible through all the assets where you are seeing the performance come through, and executing on our attractive growth projects.
That's the Chief Financial Officer of BHP, Vandita Pant there. BHP shares doing particularly well today. The company rising by 4.7% by the close, $52.74. It's the main reason why the Australian share market finished stronger today. The S&P ASX 200 at 8,958. That's a rise of 0.2% off the back of mining stocks doing particularly well. About 5 of the sectors finishing in positive territory. Materials doing best, followed by consumer discretionary and consumer staples, the worst performing property-related stocks and energy. So the best performer on the market today was JB Hi-Fi, up by 8%, building on the gains it made yesterday following its profit results. Pro Medicus up by 7.6%, and the A2 Milk Company also doing well again today, shares up by 6.2%. The worst performer following its profit results, Reliance Worldwide, down by about 9%. That's a plumbing company. Lynas Rare Earths down by 5.5%, and Treasury Wines continuing to extend on the losses it made yesterday, shares down by 4.6%. For more on the day's market action, I spoke with Jonathan Shead. He's the head of investments at State Street Investment Management. Jonathan, how would you describe investor sentiment at the moment?
Investor sentiment is something we track on multiple measures across the globe. And right now we're seeing, I'd say, broadly positive investor sentiment. There's no question it's moderated a little bit over the last few weeks, but still broadly positive, which is usually good for growth investments like equities.
We're in the middle of reporting season here in Australia. Based on what you're seeing, how would you describe the health of listed companies and some of the key themes that you've been seeing?
Well, so far it's been okay. I wouldn't say great. It's been okay. Probably some of the more traditional companies like banks or materials or utilities have perhaps done a little bit better than some of those growth and technology names. But so far, it's been okay. We'll be watching the second half of the season with interest, that's for sure.
The RBA board minutes came out today. It follows its interest rate rise in February. We've got the wage price index tomorrow, labour force data this week. What's your take on Australia's economic environment and the interest rate outlook now?
Yeah, the RBA minutes confirmed, I suppose, what we already know, and that's that the RBA really felt they couldn't let inflation keep running at its current level without taking action to bring it down. Clearly the RBA has been considering a possible interest rate increase again later in this year, and the minutes confirm that. But that's not a sure thing, and it could go either way from the RBA minutes. Clearly, this balance between what's happening in the labour force and what's happening in the economy more broadly, or inflation, has been a significant consideration for the RBA. And so those wage and unemployment numbers later on this week are going to be watched very closely. The RBA is of the view that the labour market should hold up okay. I think we're probably short term would have a similar view. So maybe 4.2%, a slight nudge up in the unemployment rate, probably not much of a shift in the wage price index for sort of the mid 3% kind of number. We're broadly in line with the market there, I think. That said, I think there is an outside case that we may get some easing in demand towards the back half of this year. I think if you look at the consumer sentiment numbers after the first increase came out, they really took a bit of a hit, which is unsurprising. But also on the business side, we saw some softening in business confidence following that increase at the February meeting. And so we think there is a chance that demand might ease, and we might get some of that inflationary pressure starting to ease. The thing is that the RBA is clearly so focused on getting inflation back inside band that it would have to be a pretty big drop in demand, I think, for the RBA to change course at this point.
So if rates in Australia are rising, what about the US? Is it still on an interest rate path lower? And what does it mean for investors?
Yeah, we are in the somewhat unusual situation where Australia is leading the pack, as it were. Other than Japan, Australia has increased and most other countries are still on an easing bias. The US, we think probably 3 more cuts over the course of this year. That'll be great for the US economy, obviously helping to support growth. I mean, the US has had arguably a somewhat fragile labour market of late. We've seen some of those job openings start to fall. We've seen early signs of some possible increases in layoffs in January. So the labour market in the US is looking a little bit fragile, but those interest rate eases will help both corporate earnings and also the broader US economy. I mean, corporate earnings in the share market look reasonably good towards the end of last year, and they're looking fairly healthy into 2026. So we think the US economy looks pretty resilient, and we're quite constructive on the US equity market at this point in time.
So last year, AI was a key theme. Do you think it'll continue into 2026? And what's interesting is that if you're implying that interest rates will fall in the States, right? That's generally good for those companies borrowing to invest in AI, no?
Yeah, indeed. And there's been plenty of borrowing to invest in AI of late. I mean, I think if you were just to use share market prices as your bellwether, you'd have to say AI is off to, should we say, an inauspicious start for 2026. There have been some quite big price falls and some quite high profile names. But we think AI will be a big theme again in 2026, not necessarily because 2026 is special, but just because we think this is a multi-decade thematic. This is a fundamental structural rewiring of how the world actually operates. And that can be a really bumpy ride. Perhaps the closest parallel would be the internet 20, 25, 30 years ago. If you think about it, we're still seeing the effects of that today in advertising or in social media or in e-commerce. And we think AI will similarly play out over many decades. If you look at the steps to go through as AI gets through the economy of the sort of 3 or 4 major steps, we're maybe partway through step 2 at this point. So the stakes are enormous, but it'll be potentially a bumpy ride, as we've seen from the first few weeks of this year. I think for investors, watch out for things like what's happening on electricity. AI uses huge amounts of electricity, and so what happens on the grid, both in Australia but also in the US and other countries, electricity capacity, engineering for efficiency and so on, electricity, watch that. Watch chip shortages, whether it's through trade or through kind of manufacturing disruptions. That's another one to watch out for. And then regulation blowback. We've actually made headlines around the world with our social media ban for kids, but there's other areas in content moderation or privacy or all sorts of areas where you might see unexpected regulation blowback. So I think it's really about staying invested, being diversified, being patient, and expect to see many more bumpy months like we've seen over the last month or two.
And so apart from AI, what else do you see as the key investment themes for the year?
I think we quite like small companies. We've actually been saying this for a little while. We quite like small companies in the US. It takes a little while for things like the One Big Beautiful Bill impulses to come through into the smaller company segment in the US. That, along with, again, falling interest rates in the US, we think will support that part of the market. Some of the tech names are pretty dazzling when it comes to AI, but there are other areas like communication services. Again, think retail, think advertising, or industrials. Again, electrification, engineering, automation, robotics, and so on. There are lots of segments like that that look quite interesting. Emerging markets, we think, is going to be an interesting place to look in 2026. So emerging markets are often helped by a weaker US dollar that we're seeing at the moment. Add to that looser liquidity, and also the fact that many emerging markets play an important part in that technology supply chain. So we think emerging markets are an interesting area to look. And then finally, I would say just make sure you stay diversified. Things like gold or commodities, or if you're very careful, private market exposures are not a bad way to help balance your investments out for 2026.
That is Jonathan Shead there from State Street Investment Management, and he wraps up the podcast for this Tuesday. Give it a rating or review on Apple Podcasts and Spotify. Click subscribe, and I'll see you tomorrow. This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.